Don't make these 10 investment mistakes. Don't invest another dollar until you hear this. These are the top 10 things that rob you of your hard-earned wealth. Not only costing you money, but destroying your peace of mind. And then we'll talk about what to do instead. See, some of the top problems with investing are relying too much on compound interest. Get you to wait way too long. I'll go into that detail. There's plenty of goals that actually create risk, and risk doesn't equal return. A lot of people confuse investing with speculation. A lot of investing reduces responsibility. It abdicates that responsibility and creates far too much risk. Some people feel like they're diversified, but they're in too many of the same asset classes. People think that risk tolerance matters. It's not risk tolerance, it's risk mitigation. Far too many people are accumulating money, waiting for 30 years, hoping it pans out, finding out later. The U.S. Department of Labor says that 95% of Americans are not financially independent by age 65. Another piece is partial planning, and then issues with time value of money, feeling like it's too late or trying to make up for lost time. So, look, money loves speed. And the fast money is you got to know your investment index. There's a cash flow index, whether it's you're borrowing money or whether you're investing. It's you simply take for a loan, the loan balance divided by the minimum payment. That tells you a cash flow index. If it's less than 50, you got a cash hog on your hands. It's costing you way too much. Now, cash flow for investing, you want that low number because it's cash flow coming into you. So what have you allocated toward the investment? What's the deposit divided by the cash flow? You want that to be 50 or less. If it's above 100, it's really not doing that much for you. Simply looking at reallocation could be key. You might have underperforming assets that aren't getting a lot of interest, and higher interest rate loans. Just paying those off gives you immediate cash flow improvement without any risk. Part of this is just understanding that economic independence is the key. So let's get deliberate. Economic independence is having enough cash flow from your investments to cover your basic expenses. That's economic independence. That means every active dollar you earn can help you grow assets because it's not encumbered by your personal expenses and your lifestyle. That's a game changer. You see, that's like a 10 times advantage. See, years ago, I wrote this book. It's a New York Times bestseller called Killing Sacred Cows. Now, that sounds cool. When I did my very first podcast, the guy kept calling it Killing Scared Crows. Killing Scared Crows over and over for the entire 90 minutes. Seriously, what would that book be about? I guess like an apparent terrified bird murder enthusiast. I mean, it's kind of crazy, right? And he just kept saying it over and over. I tried to correct him at the end. He said, well, what do you think I should invest in? I was like, oh, I know for sure. Bifocals, literacy, a new career. See, the book dispels these crazy myths around money that we buy into because, well, it's kind of a ream. Work hard for your money. Get over promised on what will happen to it. And then you have to keep working, hoping that one day life will get better. See, I've made money and I've lost money with investing. I've been lucky and I even confused it with skill. My first home I bought at 19. I used this thing called a champ loan for the down payment. The property was under $100,000 and it sold for $170,000 a few years later after college. I thought, man, I'm so smart. It was just timing. It wasn't like I really did a bunch of due diligence. The next investment I made in real estate, well, I gave $25,000. I lent it out for 3 months and got back $50,000. That's a 400% annualized return. I'm a genius, I thought. Then my third deal, even better. No money down. And I had a friend that said, look, he had a close friend that just got a new job, but was late on his payments, and he was going to lose his home. So I bought the home, so it didn't go to foreclosure. And he said you could split the equity when he improves his credit and refinances. We split $190,000 2 years later. See, confusing luck and timing with skill, that's what creates risks. If you grow your money without growing yourself, that gap is called risk. So after a quarter of a century in finance, interviewing 21 billionaires and going through multiple market cycles, like 2000 to 2002, 2008 to 2010, what happened in 2020, here's the biggest issues that are costing you money and destroying opportunity with investing. There's just so many myths out there, like high risk equals high return. I mean, what drunken Wall Street idiot came up with this strategy? Risk means chance of loss. So how in the world does increasing your chance of losing help you win? Sorry that you risked and lost all your money in Vegas, but don't worry. You're in it for the long haul. That's another myth. You're in it for the long haul. You never hear that about anything good. I think it kind of sounds like condolences, right? You don't want to get a call from your mechanic or dentist saying that you're in it for the long haul. So why would you want to hear that from your retirement planner? You wouldn't. Look, the only people in it for the long haul, that's truckers, That's one long haul you don't want to make. It's all speed and hemorrhoids, just pushing through to reach your destination. Well, I guess that kind of sounds like retirement. So let's look at the investing mistakes, myths, and misinformation that's out there. The first one is not recognizing the real cost with the time value of money. Time value of money is a financial principle saying that a dollar today is worth more than a dollar in the future because it can earn over that time, right? So in essence, money available now can be invested to earn interest or returns, making it more valuable than the same amount received later. Plus, we have inflation. So there's this myth with that of it takes money to make money. It doesn't take money to make money. It really takes relationships and ideas, value and exchange. Let me give you some examples. When I wrote the book, Killing Sacred Cows, Killing Sacred Cows right here, I did this thing called pre-selling, where I pre-sold 22,000 copies of the book before it ever came out. That gave me all sorts of upside potential while bootstrapping with entrepreneurship. So I reduced the risk of writing a book and having that book just sit in the garage. A lot of people spend all this time writing and they don't think about that. I mean, we've seen pre-selling. I've done it in other ways. My first digital course called Freedom Fast Track, pre-sold it for 50% of what the cost was going to be when it was finished, had the people that bought it early give me feedback, asked for their patience since I was charging them less as we rolled everything out, and that if they loved it, they could endorse it. See, I reduced the risk. I still created the potential profitability, but I did it immediately versus just waiting for the long haul. The long haul gets people to abdicate responsibility. I think this will work out in 30 years, but again, the U.S. Department of Labor says 95% of people are not financially independent when they're age 65. It's because they don't know about creating cash flow along the way. They don't know about mitigating risk and protecting the downside. They're just hoping that it works out with a set it and forget it mindset. So a lot of what we neglect in that kind of, time value of money, I just got to start early and then I'll just wait, is we don't invest in ourselves. We don't increase our skill sets. We don't develop what I call mental and relationship capital. There's this thing called the value equation. The value equation is pretty simple. It's our mental capital multiplied by our relationship capital. That determines our financial capital. So if you want more financial capital, it's really how effective can you bridge your mental and relationship capital. I call that bridge business. So how do we serve others, solve problems, and add value? So if you have a lot of knowledge, ideas, knowledge, wisdom, insight, strategies, and tools, but you keep it to yourself, you're not going to make money because it's about reaching people. Now, some people say it's not what you know, it's who you know. Well, if you don't know anything, it's not going to lead to financial capital. You've got to bring something to the table. So a lot of people have most of their wealth stored in relationship capital because they don't ask for support. They don't know how to effectively take that goodwill and turn it into profitability. This is something that the best business owners do great with. They're willing to ask for support. They're willing to hire. They're willing to tap into other people, networks, organizations, mentors, friends, even family. That's relationship capital, the most underutilized but one of the most important forms of capital. Most people wake up and they go, how do I make more financial capital? And this leads to risk because if they don't have the mental capital and they invest the money, well, they don't know how it's going to work out. They're just trusting someone else and hoping for the best. So what happens quite often is we neglect our mental and relationship capital when we get in a mindset of time value of money, of you just got to start early, invest early, often, and always. But if we're neglecting due diligence and protecting the downside, if we're just hoping for the best that compound interest will save us and get us there, well then, even if that money grows, do we grow with it? Do we know how to protect that downside? Do we know how to get an exit strategy or create cash flow along the way? The other problem with time value of money is it gets people to think really miserly and we can miss out on memories. I remember telling my dad when I was really young, we're driving, I remember we had this old 1984 Chrysler New Yorker. It was a car that if you open the door, it would say the door's ajar. We thought it was so advanced with the computer and technology. And we're driving down Main Street of Price, Utah. And I told my dad, I'm going to work harder than anyone else can work so I can live a life like no one else can in the future. He said, I appreciate the work ethic, son. I do. He's a coal miner. He said, what about the memories you miss out along the way? You can never get those back. What about not enjoying any quality of life? There was a time in my life where I saved 50% of every dollar I earned, and I was just obsessed with the time value of money because I was in my 20s. I'm like, if I just start early, this is going to be so great for me in the future. But then every time I wanted to invest in myself or increase a skill set or hire someone, I was always thinking about time value of money. So I was thinking but then that's not going to compound. So there's a basic formula for future value, right? So the future value of money versus the present value. Time value of money is saying, hey, dollars today are worth more than dollars in the future because you can invest and grow that money. So you look at the present value of the money and the future value of the money, but you look at the interest rate or the rate of return you can have over a period of time. If you invest $1,000, at 7% for 5 years, that's going to grow to $1,402.55. So it's like that $1,000 today is worth $1,402.55, not taking into consider inflation. So that time value of money, there's a chart that I'm going to show you here. So in this chart, we're going to look at is, what if you invested $2,000 a year for 10 years, right? From ages 20 to 30, then you stop and never invest any more money. Versus, what if you invest $2,000 per year from age 30 on, right? You're going to go all the way till age 60. What you're going to find is, just by investing in the first 10 years, there's going to be more money than if you invested the entire time, right? Because this solid line doesn't even meet, even though you've put in $2,000 for 30 years versus 10 years. So you put in 3 times more money, and you don't end up with more money because of that time value of money. That's the miracle, and that people get so excited about, compound interest. The orange line is showing what happens when you start late. The dotted line shows if you just start early enough. But what happens if you didn't start early? What if you feel like you're behind? This is where a lot of people get into taking too much risk. So yes, it is true that even though you've invested 3 times more money, your final balance is lower. But it's also not really looking at opportunity cost. Because what happens if we invest in ourselves? And by investing in ourselves, we launch a business, we build infrastructure, we hire people. And that doesn't grow our bank account initially, but it could grow equity in that business. It can grow cash flow that comes in even when we don't show up that day. So it's so exciting for a lot of people if they can just start early enough at 20 and invest for that first 10 years, that it has all this potential for growth, even if they don't keep putting money. But if that's at odds, what's the opportunity cost of growing your skills, of increasing your ability to deliver value? So that's one of the concerns I have with this time value of money concept. It also doesn't take into consideration what happens later on when we have a loss. See, because if you start out with $100,000 and you can invest that for 30 years at 10%, that's going to grow to $1.74 million. But what if you had to lose 10% just one of those years? What year would you want to lose? Most people think, well, that first year, because it's only going to be a $10,000 loss. But it's $10,000 compounded at 10% for the next 29 years. So even though if you waited till that last year to lose, it's going to be a much bigger number, like hundreds of thousands of dollars. That $10,000 would have grown to hundreds of thousands of dollars. So it doesn't matter whether you lose year 1, year 15, or year 30. It's all the same impact, because we have to see what most people don't, which is opportunity cost, which is having the eyes of economics, which economics can seem boring and maybe even intimidating, but I'm really looking at simplifying it here. Is that, yes, time value of money matters. It's part of the equation. And if we delay for too long, well, we're not going to get a lot of money with 10 years of compound interest. Compound interest is a 30-year proposition. It gets the hockey stick from year 20 to 30, where it really starts to grow when we reinvest every dollar that we earn. But the reality is, over 10 years, it's a little bit more anemic. To know this, you can use something really simple. It's called the rule of 72, okay? So you just take whatever the interest rate that it is you're earning, and then you divide it by 72. So if you're getting 10%, it means your money will double every 7.2 years if you're earning 10%. Well, again, over 10 years, yes, it more than doubles, but it's not exponential like when we look 30 years. So what you have to consider is, yes, you want to start as early as you can, but you don't want to get defeated if you feel like you didn't start early enough. And you don't want to consistently go, well, I want to just see this bank account raise. I just want to see my mutual funds or my retirement plan increase in value at the expense of developing yourself. School isn't just what we get when we're in the classroom. School is exponential skills like marketing and communication. It's learning about how to leverage and utilize social media in a way that could benefit your business. It's about learning how to hire, or learning how to build systems and processes that create a lot more scale and leverage that allow you to delegate the things you don't love to do and do what you do very best. And if that entire mindset is about what you can save or what you can invest outside of yourself, where you have little control, that can create unnecessary risk. And this is part of the problem with investing. I highly encourage people to invest, but what does investing look like? Is it just products? Is it just retirement plans? Or is it those skill sets? And it's not that it's an either or. And it's not the worst thing to delay a year or two to invest in you, to invest in the things that help you grow, whether it's joining a mastermind or whether it's hiring a mentor, or again, whether it's the infrastructure that you build within your organization. So that's the first thing, is overemphasizing time value of money at the expense of investing in yourself and not understanding opportunity cost. The second big mistake with investing is when we confuse asset gatherers with asset managers. And look, in 1998, I got life insurance license, and then a few months later, I got a Series 6 and 63, meaning I could peddle and promote mutual funds. And so I was out there selling these. But I wasn't managing the money. I was an asset gatherer. I never met the fund managers, and some of the fund managers changed over time because they retired or they went to a different company, and they didn't change the name of the mutual fund or anything like that. All the statements looked the same, and I wasn't even notified, or if I was, it was buried deep in that prospectus. So it's not like the person you're talking to is often managing your money. They're gathering the assets and selling you a philosophy. Some people say they have no luck when it comes to money, by the way. My investments just don't work out. Well, maybe you're looking in the wrong place, like the mirror. Or maybe money just feels elusive, like a fairy tale or mythical beast, or an honest broker. I mean, think about it. An honest broker. It seems like an oxymoron, right? Does Wall Street really have a brand that you would trust anywhere else? How about Wall Street Daycare? You taking your kids there? Oh, sorry, we lost 8% of your baby today, but don't worry, it's just toes, and he's got more. Toes grow back, right? I mean, asking Wall Street to handle your money is like asking an arsonist to run the fire department. Shit, it's like asking a stripper if you're handsome. Oh, you are? Well, you're paying me. What's in your wallet? Not even self-esteem. When that stripper gets done with you, turns out it's not good for you at all, right? So if we confuse asset gatherers with asset managers, then quite often we're buying into marketing and hype and not really getting what we think we're going to get, because it's all mountain charts and marketing, not actual strategy. The third thing, and this is probably the biggest mistake with investing, is just this entire accumulation mindset. The mindset that there's three things we focus too much on. One, this notion of it takes money to make money. So we just think, oh, we got to save more, and it gets us to think about, putting money aside that might have better places to go. Like some people take really good money from their business and put it in bad investments because someone else is doing it, or they think they've got to do it, or they feel guilted into it because they don't have enough in their retirement plan. So the second thing is high risk equals high return. Risk means chance of losing, as I said. So don't just increase your chance of losing, because risk doesn't always equal return. And the third thing is you're in it for the long haul. So most people believe in this accumulation mindset of wealth, which is money is a function of three factors. All right, so let me show this. In the world of accumulation, most people believe wealth is a function of these three things: money times rate times time. So if you want more wealth, you got to add more money, or be willing to take more risk, or be willing to wait longer. I remember I used to read Money Magazine, and all the time it would say, oh, the market's not doing well. It's the time to buy. It's on sale. Well, it would have been nice to buy, not buy before the sale happened, right? Or, you know what, you just got to wait longer because, again, going back to time value of money, because it didn't perform at the time that you needed it most. Or just take more risk. Risk is probably what got you in the place of the trap of not having the money that you wanted. So this notion of accumulation is problematic because it's not focused on cash flow, which cash flow is what creates financial independence. So if you don't know how to create or handle any asset to create cash flow, how is it that when you retire, all of a sudden you're supposed to become an expert at it? See, there's something called disinvesting that happens in the future. See, investing is we put our money in and it grows. Disinvesting is now it's time to take our money out. And if the market's going up or down, when it's going down, if we pull the money out, it's disinvesting. So there's this thing called the 4% rule. That says if you take more than 4% out of a variable volatile account, you run the risk of depleting the account. Because if I have $1 million and I take 10% out and the market earned 10%, I'm still $1 million. That's good. But what happens if it goes down 10% and I take 10%? Now I'm down. Now I've lost that money and I pulled money out. And so I'm 20% disadvantage. Now even if it earns 10% or 20%, I'm not even back to where I started because it's 20% of $800,000, not of $1 million. That's disinvesting. And so that's one of the issues with accumulation is neglecting cash flow along the way and now having variable accounts. And that's why a lot of people move to fixed income, like bonds and things like that. But even then, what if interest rates are low? So this long haul notion can be really problematic for people because there isn't that accountability. They've just deferred their tax. They don't know how to get the money out of the plan. There is no exit strategy. This is a major problem with investing. Now, another one that kind of gets me is this notion of risk tolerance. Have you ever had people ask you, hey, on a scale of 1 to 5 or 1 to 10, how much risk are you willing to take? Well, look, if we think risk equals return, we're going to have a bias to say a higher number because we want to get that return. But what happens if that money loses or that company goes out of business or it's no longer there? If you get asked the day after, hey, you just lost your money, how much risk are you willing to take? You probably want to punch them in the throat because we don't really have risk tolerance. We just have confusion about an improper philosophy. It's not about risk tolerance. It's about risk mitigation. Risk does not equal return. Risk is your chance of loss. So how can you create real due diligence? Look, I've got examples of risk mitigation and due diligence in killing sacred cows. And I'll hook you up. Just put KSC. Go on to Instagram and DM me, KSC and Investor DNA, and I'll get you a tool that'll help you to understand how to mitigate risk. It's really these 10 questions that say, how aligned is the investment with your knowledge? What's your exit strategy? How good are you at protecting the downside? So you can understand, is it aligned with who you are as an investor? So the best investors, some people say on the outside, oh, they're so good at taking risk, but no, they're the best at mitigating risk. The next issue with investing, a lot of people aren't actually diversified. They're in one asset class. They have multiple ETFs or mutual funds. But guess what? In that mutual fund, if it's all growth mutual funds, you're going to have some of the same crossover with the same stocks and the same objective. Those objectives have limitations. Growth funds have to stay in growth. Jeffrey Vinnick, he used to manage the Fidelity Magellan Fund. At the time, it was the biggest mutual fund on the planet. And in 1998, he decided to move some of the money to cash and move some to fixed income. But that was against the fund's objective. So he got fired and sued, even though he was right, because there was a major downturn in 1998. But there's limitations with that. So if you think you're diversified through just stocks, stocks are only one asset class. There's gold, there's silver, there's crypto, there's real estate, there's other asset classes. And so a lot of people aren't really diversified. They're divorcified from the results. They don't know what's going to work and what's not going to work. It's almost like if you diversify, you're like, I don't know, maybe this will go up, maybe that'll go up. Let's just spread ourselves thin. But not understanding how things work and getting too many things involved or being involved in too many things, that could be unstable. You'd be unable to assess or pay attention to the various assets you allocate. Now, when it comes to investing, this is what I get frustrated about. It's abdicating responsibility. It's not understanding our investor DNA, not becoming better investors, but just chasing investments, just setting it and forgetting it. Investor DNA is your values, which is what's important to you. It's your competencies, where you have skills and knowledge. And it's really your drivers, where you're willing to pay attention to and wanting to pay attention. So it's about becoming a better investor. See, risk isn't in the investment. Risk is in the investor. It's not really that there's risky investments. There's risky investors, and we're taught to be risky investors by not learning about what we're doing. So maybe you get lucky riding the wave, but not understanding the exit strategy or the impact or why it would work or when it wouldn't work. For example, let's just say that you have a mutual fund. And in that mutual fund, there's so many different companies, but one of those companies goes bankrupt. Now, that company that goes bankrupt is no longer in your portfolio. They just add a new company if it's the S&P 500. But that one that went bankrupt will impact you in those dollars because they're gone. Now, the average return might be higher because they've added this new company in there, and that's looking at the return. But what about the dollars that you lost? There's a difference between average return and actual return. I'll just show like a simple example here. Let's take a look at average versus actual return. It would never quite be like this, but let's just say you have $10,000. And it's amazing. You earn 100%. Boom. Now we're at $20,000. But the next year, you lose 50%. Oops. This is before fees or taxes. Now you're back down to $10,000. But 100% minus 50 is a positive 50 divided by the number of years, too. Your average return is 25%, but your actual is a goose egg. It's zero. So volatility has a major impact on your overall return. Companies go out of business, ups and downs because there's fees that come out of that. And we're not even accounting for that. But if the market rallies and you get back, you lose 10%. Now you're down to 9,000. It rallies, you get 10%. You're only back to 9,900. And going back to time value of money, you've lost that year. So this is a major impact and something to consider when it comes to investing. If you can improve where you don't have as much volatility, there's extra benefit to that. Now, another issue, speculation and gambling disguised as investing. If you don't know when you're going to benefit, how you're going to benefit, how the investment works, what could go wrong, how you can protect the downside, if you're not clear about the value proposition, like if I'm giving someone money and they're getting a commission on that, the value to them is they get the commission. The value to me is I'm hoping you get a return, but what is going to happen in the marketplace? How is it going to add more value in the marketplace that there's enough money to pay me a return? If you're not clear about the value proposition, there's too much risk. And finally, with speculation, sometimes we just confuse luck and skill. Or, the proverbial count chickens before they hatch. We make money on paper before we realize the gains in our life. And sometimes people start to spend that money mentally because oh, look how good this is. Look how good I'm doing. Now, the eighth issue with investing is creating goals that will create risk without reward. Targets move. So what happens if you're like, I want to have this amount of money in the future, and then it's not performing? You're like, well, I guess I'll take more risk. See, needs-based analysis is not rooted in reality. Like we're like, this is how much I'm going to need in the future. We don't really know how much money we're going to need in the future because things change. New technology comes out. Inflation exists, and what used to, our dollar used to go further than it does today. So sometimes needs-based is how much you need in the future. We're trying to predict something we're not qualified to answer or understand because the luxury once enjoyed becomes a necessity because quality of life might matter because new inventions might come out. And so then they go, here's how much you have to save at this interest rate, but you'd have to save more at a lower interest rate. So it gets us to gear towards risk because of the moving targets and because the goals aren't rooted in reality. Number 9, I just feel like stocks are synonymous with investing in most people's minds. So not considering other asset classes. It's just stocks because stocks, have had a higher return than other asset classes. Well, if that's true, Bitcoin's crushed stocks, but a lot of people don't understand it. So is that a good investment for them? I mean, maybe your stocks, when they go down, your mindset follows with it. You are your greatest asset, not that stock. And if it starts to, even if it was getting a 20% return, but you're losing sleep, you're fighting with your spouse, you're not sure how long it's going to last, that's a problem because it's going to harm your own production. So other asset classes could be real estate. It's not for everyone. Again, risk is in the investor, not the investment. And there's 1,000 different ways to do real estate. Might be in business and creating a business, buying a business, expanding your business, but not everyone's an entrepreneur. Might be in intellectual property, like the books that I write, right? That's an asset class that's hidden from most people, but one of the greatest asset classes that's out there because I could live anywhere in the world. I'm not paying property taxes on those pieces of property. I'm just paying when I sell. So if I sell a book, I pay the tax on that. But again, what is the asset class that's going to create the most cash flow for you? And is an over-reliance in stocks creating unnecessary risk because you think you're diversified, but you're in one asset class? And finally, this one might be a little bit more controversial. I mean, this is something I really believed in the past and thought this was the only way to go, was the compound interest. We hear it's the eighth wonder of the world. That Einstein said that. Einstein didn't say that compound interest was the eighth wonder of the world. He went to a conference in Austria in the 1920s. He said compounding numbers. Then Security National Life misquoted it in an ad saying it was compound interest. So, see, compound interest can come at the cost of your financial independence. Financial independence is creating enough cash flow from assets to cover your basic expenses. And if you have to wait for 30 years for compound interest to work and you neglect creating cash flow along the way, now you get to a place where it's all about retirement. And in retirement, the outcome of people's income is outside of their control because now it's in an investment that they don't know a lot about. And when they go to create cash flow, which they haven't created for the last 30 years because they've been reliant on only compound interest, they're ill-prepared. And they really become susceptible or in financial bondage to 3 key areas. The first area that they're susceptible to, well, tax changes, right? What if taxes go up? Your income goes down if all your income has been deferred in tax. Or what about inflation? Inflation could be confiscating your purchasing power. So if you're on a fixed income, each year you're getting less and less. I have a friend from Texas that called the Alpo curve. He said the same dollar isn't buying as much, so you better get used to buying Alpo. I'm like, what do you mean? He goes, 1 scoop of Alpo in your ground beef, you won't notice it. Second year, 2 scoops. Eventually, you can just live off it. I mean, it was just a bad joke, but at the same time, you get it. It doesn't prepare for inflation. And the third one is interest rate fluctuations, right? Imagine people in 2022, they go to retire. Interest rates are like an all-time low. So their bond portfolios are barely spitting out any money. If they had $1 million in bonds, it's giving them like $20,000 a year. That's not good. We're potentially going to have tax hikes because the government right now is $36 trillion in debt. We're seeing that there's maybe not what's going to happen, but at the time, that was a big part of the conversation. And inflation was skyrocketing. So their dollars are becoming worth less. They're not getting a high interest rate. And by the way, when interest rates started to increase in 2023, the value of their portfolio went down because they'd have to sell it off for less than what they originally had in value because they could go buy new bonds at a higher interest rate. There's an inverse relationship. See, as interest rates go up, bond values go down. Why is that? Because if I can go buy a new bond at 5%, why would I buy yours that's at 2%? You'd have to sell those bonds at a discount, so I'm still, in effect, getting what the new bonds would pay at 5%. So let's think about this. If you're too reliant upon compound interest, you could be neglecting cash flow. If you have goals that are unrealistic that you're trying to get to, it's going to make you susceptible to trying to take more risk to chase that return. So many people are collapsing the word investing into something that's really just speculation and gambling. Accumulation doesn't have people focus on responsibility along the way. They don't know whether it's going to work till it's too late. Most people are not diversified. They're in too many of the same asset classes. They're taught to take risk and then just tolerate it because it's the only way to go. They're in accumulation, just setting it and forgetting it, hoping it's all going to work out, but 95% of the time it doesn't. And there's a lot of partial planning where there's things that are missing and that we're over-reliant upon that risk versus creating a plan that's tax efficient and we're plugging financial leaks and focus more on cash flow and mitigating risk. And then finally, we feel defeated if we start too late because of the time value of money. We don't consider investing in ourselves or the opportunity cost of what we could earn with those dollars somewhere else. So let me rant for a minute. Set it and forget it. Where does that work in any other area of life? Starting early, often, and always without accountability gets us to be brainless and mindless and is the lowest common denominator with our cash, but it's what we've been trained. We've been indoctrinated to trust people that might not be trustworthy on Wall Street. We've been taught to dollar cost average. Who wants to be average here? Dollar cost average says we don't know whether it's going up or down. Just buy every single month because sometimes you're buying less shares, sometimes you're buying more, and just keep doing it no matter what. But what if that no matter what isn't actually benefiting you? It's the abdication of responsibility. It's personal neglect, but it's what everybody else is doing. But wealth doesn't come from doing what everybody else does. Wealth comes from cash flow, plugging financial leaks, growing your value and being of more value to people. It comes from serving others and solving problems. It comes from vision in a container that others are inspired to be part of. It comes from being a business owner, an entrepreneur, and creating upside potential for people that work for you. It comes from knowing how to market and how to sell. It comes from proper communication. It comes from so many other factors. But when investing is relegated to just be about product, there is no magic product. If there was, we'd all own it. Just like there's no magic pill in health. We don't just take a magic pill and then we're all healthy. You've seen the commercials. You take the pill and it gets rid of the one issue and it creates 10 other issues, whether you fall through the field and find out your leg is going to fall off or you might have a stroke. I mean, it's crazy, the side effects. There's side effects from bad investing. It's time to take responsibility. It's time to build this on the proper financial framework, which takes me to what would money Jesus do? I've said it before. I've spoken at events where people introduce me as money Jesus, and I get that's flattering. But to be fair, I don't really look like Jesus. I look more like the Jesus you take a selfie with at Whole Foods, right? But here's the solution. Financial independence. Financial independence is having a recurring revenue from assets, aka cash flow, to cover your expenses. There's 5 levers that create leverage without having to risk your money. The first one is plug your financial leaks. Don't overpay on your taxes, which 93% of business owners do. Don't overpay on interest, which almost everyone does sometime in their life because they don't know how to have the right credit score or the right collateral or the right cash flow reporting or the right connections that help them to pay less interest to the institutions and keep more in their pocket. It's about not having non-performing fees or hidden expenses inside of your investments that create drag. It's about protecting the downside. And then finally, it's about designing insurance properly so that you have transferred the catastrophic risk, not the inconsequential, so you plug financial leaks. Number 2, engineer your wealth. What is the amount you need every single month with expenses? Reverse engineer and say, how much cash flow would that have to be? And is there ways to pay off loans to get there? Is there ways to invest your money to produce that cash flow with lazy assets that aren't creating cash flow right now? Is it becoming a better investor? Is it growing your business through people, processes, and the technological procedures? These are the different factors of the 5 levers. The third lever is accelerate investment income. Become a cash flow investor, not an accumulator. The fourth is to scale business revenue. Where could you invest in business to create more output? Output that creates equity and cash flow and allows you to have some influence and control over the outcome of your income. And then finally, make it count. Treat yourself as your greatest asset. Create a life you don't want to retire from. Design a life where you have energy, where you're a value creator, where you're serving and solving problems. That's the key. So plug financial leaks, engineer wealth, accelerate investment income, scale your business revenue, and finally make it count. Treat yourself as your greatest asset. How do you do all this? You accelerate wealth, not accumulate wealth. You focus on how do you make more money. Is there a way to serve more people? Is there a way to collaborate and connect with others? Are there areas where that you can reach more people or more deeply impact the people you currently reach? Number 2, keep more of what you make, just like we talked about in the first lever. 3, grow your money aligned with your investor DNA. Don't speculate and take risk. Become a better investor. Have a good financial team. Learn due diligence. And then the fourth thing is grow yourself. Again, if your money grows and you don't grow with it, that gap is called risk. You become a steward. Risk mitigation and due diligence will transform everything. Knowing your investor DNA, that is the key. I'll give you a free copy of Killing Sacred Cows. Put KSC, go ahead and DM me. Just DM me on Instagram, Garrett B. Gunderson. I'll give you the PDF and I'll give you the course to help you discover your investor DNA, to become a better investor, to create more cash flow along the way, to use the frameworks that lead to financial independence instead of the faulty frameworks and dogma of investing through accumulation. It's time to revolutionize your finances and take back control of your finances and your life.